difficulties that people are having with the weather this morning. So we want to begin. And also, to start with, I want to acknowledge Senator Drazkowski, who was the teacher yesterday about the committee rules. And the minutes will not show any abstentions. That rule does not, is not in play, and it will not show a no vote from Senator Weber. When, if there had been a call for a division, then the numbers would have been taken and someone could have spoken out. But that only occurs on a roll call otherwise. So thank you, Senator Drazkowski, for correcting me. I was pretty anxious to indicate my neutrality and too anxious. So so you get, in our point system here, you get 5 points and I get a minus 5 points. And so I did all that before we actually have a quorum, and so that will not be part of the minutes, my admission there. At any rate, we have a quorum. You have the minutes in front of you that reflect the statement I just made. Are there corrections to the minutes? Seeing none, the minutes are approved as presented. This morning we have two presentations. The first one is by the Department of Revenue, and we welcome Commissioner Markwart and Joanna Bears to the committee to speak to us about the 2023 tax bill. Commissioner Markwart also had indicated to me previously, if there were any lingering questions about yesterday's hearing, that after the presentation, he would certainly entertain them. The second presentation is going to be from the Office of the State Auditor. We had invited, and she had accepted, State Auditor Julie Blaha to be with us this morning, but she is ill, so she will not be with us. And Jason Nord, the TIF Division Director, will be making the report. So, welcome to the committee, Commissioner. Your first appearance before in this session, and we are curious, if nothing else, about how the process that the department goes through to implement the bill, and hopefully reaching out to all taxpayers, whether they benefit or whether they are being asked to pay more, how you go about doing that in the department for the past tax year and looking forward. So welcome to the committee. If you'd identify yourselves for the record before you speak, you may begin.
Thank you very much, Madam Chair and members. I am Paul Markwart, the Commissioner of the Department of Revenue. I'm joined by here Joanna Bears, who's Legislative Director. And Happy New Year to all. And thank you for allowing me to talk about the department and how we implement the tax bills and just kind of the work. So as the chair mentioned, hopefully solve some of the curiosity of kind of what goes into that whole process. And so today I'd like to talk about how the department implements the tax bill and tax laws, but also talk about moving ahead to next year, some of the things we'll be working on, some of the challenges, and some of the things that don't always go perfect like you would like them to be. And also, before I begin, I want to say I was honored to be appointed by Governor Walz and Lieutenant Governor Flanagan a little over a year ago, and very thankful for your support and confirmation last year. That was greatly appreciated and valued that very, very much. And I've thoroughly enjoyed this first year. I've got a great and dedicated staff at the Department of Revenue. And a real source of satisfaction is getting a chance to work with fellow colleagues, former colleagues, and many of you. And that the many times I was here with the legislature and over the conference committee was very enjoyable. So thank you for that. And finally, I want to say that the Department of Revenue serves you as a tax policy initiator here in the Capitol and the government. We're here to help you, to help taxpayers, to help the state of Minnesota better administer and tax laws and work with policy. And so as we go today, and I'm very serious about this, I would like you to be very frank. So as we go through things, questions or comments, how can we better serve you as you make tax policy here for the state? So just, it's an opportunity, and I'm willing to answer any and all questions and take any and all comments or criticisms. So that's what we're here for, to make our tax system more efficient for everyone. So with that, if Ms. Bears is guiding the chart here. So there's just talking about the mission, our vision, and our work. And I'd like to just emphasize that last one. We in the department manage and enforce the collection and administration of about $33 billion annually of revenues. And the cost is roughly about $200 million a year for the Department of Revenue. I think the first year was like 188 million, but I think we'll be over 200 million this next year. And I bring that up because that's about 0.6. If you take that $200 million, it's about 0.6 of 1% of basically administering those revenues that come in. And when we talk about, like if you issue grants, you give a certain amount for administration, 0.6 is, I think, really, really good. But I will tell you, I had nothing to do with that. The Department of Revenue has always worked very efficiently, whether or not it was under a Republican administration or a Democratic administration. But I thought I would point that out because there is a lot of work, and you're going to see that for about 0.5% administration to do that, I think Minnesotans are getting a very good value for their dollar. So if we could move to the next one. Tax filing and our customers, just an idea of, in a normal year, what we're looking at as far as the work. And typically it's a little over 3 million individual tax filers. About 93% of our individual tax filers file electronically, and about 75% do a direct deposit. So that certainly makes things more efficient, and that number is constantly going up. And I also get data every day on the number of people are filing, how many returns are completed, how many refunds go out, and how quickly. And at April 15th of last year, we had completed 91%. We completed 91% of all the returns as a comparison of 88% to a historical average. And the time to get a refund back to folks as of April 15th was 9 days on the average, compared to a historical average of 9.5 days. So last year we shaved about a half a day off of getting refunds out to folks. So we keep a number of statistics because we think that's important, that we get refunds back in a timely fashion and we complete returns in a timely fashion. So there you look at some of the other, we work with all sorts of stakeholders. property tax refund filers. We work with all 87 counties and all the assessors. And of course, working with businesses all the time, including the regular corporate income tax they pay, but also the sales taxes that they pay. So if we could move to the next one.
Thank you, Commissioner. I had just an observation and a comment about the property tax refund filers. As you know, last year in this bill, and maybe you'll come to it, but it sticks out to me here, we made some changes relative to tax savings for I-10 filers. And I met recently with the, on a number of issues, but with the assessor from Hennepin County, and they reached out. Hennepin County doesn't have the most I-10 filers, and as we know, they're required to file a tax return, but they don't get all the benefits that they would get if they were Social Security filers previous to the bill we passed. And they, 35% of their 1,100 I-10 filers are now have homesteaded the properties, the homes that they own, and they will, in the future, get the benefit of the PTR and and valuation exclusions and so forth. But what was really interesting is that they found one person who had had a Social Security number for like 10 years, legally and everything acquired and whatever, and he was unaware because he was not a U.S. citizen. He was unaware that he was due those tax benefits. So really pleased. It's a small number of people. There are more I-10 filers or holders of I-10s in other counties, particularly some rural counties, than there are in Hennepin County. But I thought it was an interesting statistic, and I'm going to be asking if you all don't have that data across the state, perhaps the Association of Minnesota Counties does, and can ask the county assessors to provide that information to us. So I just kind of got stuck on the property tax refund filers. There will be more. So thank you very much, and please continue.
Thank you, Madam Chair, for that story and that advice also. All right, if we can, okay, we're on the process there. So there's kind of a timeline. Once the session ends, the first thing that happens is you have research and attorneys and so forth start looking at the language of the bills that were passed. And that part where it says synthesize law changes, that's where the standard deduction error was found by a Department of Revenue employee who caught that at that point. And so that's where, as they're looking, because the department's saying, okay, what do we have to do to change forms and to do all those type of things. So while that is taking place, the tax forms now have to be changed. And from this last year, right around 300 forms and or instructions had to be changed because of the tax bill that took place. And so those are happening during that timeline between June and August. And then the department will publish kind of what we're talking, near final forms. And at that point, we then begin working with tax preparers, our software vendors, and I was talking to our tax operation team. There's about 18 of them there the other day, and they said they do 60,000 tests on those various lines. So they'll take every line that's been changed and do tests, and they'll be working with our vendors, Intuit, TurboTax, and those, and taxpayer, and they'll go back and forth. They'll set up what are called error defaults. So let's say the maximum credit is $200, and someone accidentally puts in 2,000, it'll catch that and kind of shoot that out into potentially an early audit. So early audits are kicked out if there's just a mistake that was made that doesn't add up. And so then we have to pull that out of the system. We'll look at that and then send the taxpayer a letter or something, say, hey, can you correct this? There's a concern there. It's not an audit, so to speak, where you're going. It just catches it early so you can get back to the taxpayer. So that is constantly taking place. Then into September, October, November, publish the final forms, continuing to test with the providers, and then finally, at the end, you are ready for filing season to begin. And even, there's always kind of a soft start. Like this year, it was January 29th was the official, but people will start filing even earlier than that. So we're able to test things out. And like this year, we found a couple glitches even at that point, where we could quickly kind of fix it and check with the providers and so forth. So a lot of work goes in, a lot of testing goes in place. And if you really wanted to get into the nitty-gritty details someday, we could set that up and have the tax operation folks come in. It was pretty interesting, the process they go through. So that's how we're there. And of course, we're into the second or third week now of filing. So let's go to the next slide. So this is not a slide to go over everything that happened in the tax bill, but kind of to go over things that are new, kind of things like that, that kind of beyond the normal work of the department, things that we did this year. So as I mentioned, 300 tax forms needed to be updated. The nation-leading child tax credit, which we'll talk about a little bit later. The big area there is going to be the outreach for that. The 2.1 million rebates that went out, and we're going to talk more in depth on that. The renter's credit, moving that from a refund to the M1, which will start tax year 24. So that'll be next year that starts. There's the new cannabis tax as of July 1st. Back when I was growing up, I never thought I'd be in charge of collecting about $100 million of cannabis money. I never ever thought I'd be in that position, but we will be doing that as part of things. New tribal nation aid, $35 million a year is a new aid that's set up. New affordable housing aid is something that has to be set up that we administer. And then one thing that I thought was really nice this year is that there was a one-time 20.6% increase on the homestead credit state refund and the renter's refund. And if you had already, a lot of people, when they file their taxes, they will already file for that property tax refund. And so what we did is we didn't say you had to file again, we just automatically added that in when we sent those out. And then, of course, if you waited, you had forms that said that had that 20.6%. So what's not in here, I don't, like I said, I didn't have everything here. I don't have the Social Security subtraction. I don't have the new revenue raisers in here, the standard deduction, the NOL that was talked about yesterday, the GILTI, the net investment income, or the dividend received deduction changes. So all of those will all require changes to forms and so forth. So just wanted to mention that's not on here, but certainly something that was included in our work. Next, please, Joanna. So let's talk about the child tax credit, which really is nation leading. And so this was a major priority for Governor Walz, Lieutenant Governor Flanagan, to help eliminate child poverty. The legislature, your work, you put together and looked at combining a program that Chair Rest had initiated, the Working Family Credit in Minnesota, and the work of the House as they worked together to really target this to get at child poverty. So it was just really a great teamwork on putting together what I think was a really, really strong child tax credit. So it's up to $1,750 per child, no limit, 17 or under. It's completely refundable and permanent. About 300,000 families are estimated to benefit, to a little over 500,000 children would benefit from that. And when Columbia University looked at this, and they do this a lot, they said if we do this right and we get this out to those 300,000 families, that we can reduce child poverty in this state by 33%. Now, the challenge is you have to file taxes to get the credit. And the estimate is probably about 10% of that 300,000, 30,000 that could qualify have never filed before. And so that really leads us to the next slide, is the outreach effort. So the Department of Revenue, we do a great job with people who have filed in the past. We have, that data and so forth, but we're normally not comfortable getting out into spaces of folks that haven't filed. And so there's been all summer long into the fall a lot of planning on outreach, getting that out. So working extensively with the governor's office, agencies like the Department of Health, Department of Human Services that also have services that will come in contact with families, working with schools or counties or cities. We've been having an outreach plan on how we can get this information out. So we certainly have a toolkit on our website that folks, that we've been sending that out. We have the 170 free tax preparation sites, and thank you for the funding you provide for that, for these VITA sites and so forth. There's also a special grant this year that was to go out to grantees just to advertise the credits. And so those have been set up too. There's 33 grantees to do that. And then also individual outreach strategy to get to our tribal nations, which we know would be very beneficial. So the child tax credit outreach has been very extensive, very deliberate, and we're constantly working on that. So where are we at right now where this is, we're keeping close track of the child tax credit and who is applying, and I have updated numbers as of 7:30 this morning. So that 146 million that you have there should be now 169 million as of 7:30 this morning. 132,000 qualifying children have been claimed, and that average credit is about $1,359. So, like I said, the outreach is going to be very important. Last week was kind of child tax credit outreach. Governor and Lieutenant Governor was out and about around the state advertising the child tax credit, and that's going to be really, really valuable that we do that. Next. So let's talk about the one-time rebate. It's 2.1 million rebates were anticipated to go out. It started on August 16th or 17th, and about 1.1 million were direct deposits, and those went out in 3 days. So that first 1.1 million rebates went out in 3 days. The checks then, and we wound up having way more checks than we had thought initially. Almost where we thought it might be 200,000 to 300,000 checks, it wound up being about 1 million. And the reason why is because a lot of taxpayers, when they work through a vendor, they have the payment kind of going first to the vendor, and then the vendor takes the refund to and we couldn't send a check out where the recipient is like the second in line. So all of those, we couldn't do a direct deposit, let's put it that way, that they were second line. So we had to send a check out to that address. And so that did slow things up a little bit. US West still was able to get checks out at a rate of 30 to 50,000 a day. So it took about a month to get all of those checks out. So the first round of checks went out, and we waited 60 days. And if they weren't cashed within 60 days, they were voided. And then around November and December, a second round of checks were sent out. And if those weren't cashed within 60 days, they were voided. And that occurred February 6th, where the second round of checks were voided. We now are looking at a third round of checks, and there's still about 128,000 checks that have not been cashed, about 6% of the total. 88% of the checks were cashed, 12% were not, which is about 6% of the total. And that's to about $48 million. So what will happen with those checks if they are not cashed? We now have to wait 2 years on and I'll get back. This check that's going out no longer will have submittable on it. It will be a regular check from the Department of Revenue. So it'll look like a regular Minnesota check. So on that one, you have 2 years to cash it. And after 2 years, if it's not cashed, it's sent to unclaimed property. So like I said, we still have about 128,000 checks that fall into that category. So another big part was ensuring the right amount got to the right person. And that was, when this system was set up, that was a huge goal for the governor and for the department, is make sure we got to the right checks to the right people with the right amount. And we, as of this point, have not heard of an instance where someone who should not have gotten a check got a check, or vice versa. And we also, if you remember, it was in kind of a nondescript envelope. So a lot of people initially may have thrown some away, and I think we heard from that. One of the reasons why you have a nondescript envelope is so they're not stolen out of mailboxes. And we also did not hear of any cases where that occurred. So while there was some glitches that I want to talk about here in this, overall, when it came to getting checks out, getting them to the right people, the right amount, and so forth, it was very, very successful how that process worked. And this was the first time that checks were sent out, or a rebate was sent out since '01, so it's been 22 years. And so all of that, I thought, worked really, really well and got to what we wanted to do. So I want to talk about now, another question that had come up a lot was the third-party partnership to send these checks out. And we worked with a group called Submittable. And in the legislation, we were allowed roughly about $20 million to have a third-party vendor. So why Submittable? So Submittable, first of all, U.S. Bank had worked with Submittable for a number of years, and they always had a really good track record for performance and security. So in 2022, when the frontline worker pay was done, Submittable did those also. And so also they, so what we would do is they'd come up with all the files of everyone who qualified. Remember, we went back to 2021 returns. So they got all that information. They would process that, send all of that out. So that was very valuable. Also, because those checks and rebates were going out in August, that's the exact same time the department is sending out property tax refund and renter's checks. And so we went with the third vendor, Submittable, for the reasons listed. They're efficient, they had a good track record, and also allowed us to be more efficient in getting out the property tax refunds all at the same time, and go through the process we talked about in processing the 2023 tax bill. So in hindsight, I would have Submittable get a Minnesota post office box address. If you remember, folks were getting these checks from Montana. If you remember, they had submittable, and some might have, I know some threw them away, and that wasn't a problem. We reissued a check if that was the case. But in hindsight, now, somehow that was something that I would change from what we did.
Did you use submittable and the Montana address for the second round and this third round that's going out?
The second round, Madam Chair, yes, but now the third round are normal checks. Because our contract with submittable, I think, is up now, and we're not, yeah.
So the first and second round checks had the Montana address?
Yes, and back when we did the frontline worker pay, like debit cards were sent out, and those actually had a Indiana address, return address. And we didn't, the Department of Revenue didn't really hear anything about that, but that was a smaller number. But it just wasn't something we thought about. But in retrospect, moving forward, if there's further ones, we've got to,
Thank you.
You live and you learn.
I have some questions from the members. We'll start with Senator Weber and then Senator Nelson. Senator Weber.
Thank you very much, Madam Chair. As it relates to the rebate checks, I had a constituent contact me. Well, thank you for the explanation as it relates to the Montana Bank. I think I called you about that because I was getting calls from constituents regarding that issue. But this constituent always files electronically and everything is direct deposited if there's a refund, what have you. But they wound up getting a check and they were wondering why the difference. I mean, they're in the system, they're the, in that respect. So I was just curious as to why that might have happened.
Commissioner?
Madam Chair, Senator Weber, so there might have been two reasons for that. One could have been the case where they were second in line, like if they went through a third-party vendor, and some of them have the rebate, how it goes to the vendor first, and then it gets to the taxpayer. On that, we could not do direct deposit as a second route because it would end up going to the vendor first. So all of those we had to transfer from a direct deposit to a check. So it could have been that. The other one would have been if they had in the past, in 21, if they had not received a refund, and so we didn't have a bank routing number, and a portal was set up in July that if people wanted to update their bank routing numbers or their address, they could do that. A lot of folks didn't, but if that was the case, then we would just go to the address.
Okay.
If maybe they owed money in 21, and maybe other times they get a refund, but if in 21, if we didn't have your bank routing number, we would default to the address. Okay. So, without talking with your constituent, we wouldn't know for sure, but that could be a possibility.
Okay, very good. Thank you.
Thank you. Senator Nelson.
Thank you, Madam Chair. Commissioner, thank you for the overview. Just on this part, I have two brief questions. Just one, refresh my memory. I'll give you both questions. They're pretty simple. Refresh my memory on the amount of those one-time rebates that Minnesotans received. And then also, do you know the total cost to the department to implement? So you mentioned the $20 million to submittable, but there's, second rounds and third rounds and that type. Do you have an estimate on the total cost of the program?
22 total. Yeah. Madam Chair, Senator Nelson, so on the first question, it was $260 per person, and then you could receive $260 up to 3 children for a total of $780. So the maximum credit for a family of 5 would be $1,300. And the second question, I think there was a total of $22 million that was authorized for administration. And so I know submittable's 20. I'd have to get back. I mean, I'm thinking the department now is 2 with that, but I I'd have to get back to you on that,
Thank
Senator.
thank you. We can get that at the, when it's
Yeah.
finished, get its total number.
Yeah.
Thank you, Madam
Fine.
Chair.
Thank you very much, Senator Nelson. Anyone else on this item? Senator Drazkowski.
Thank you, Madam Chair. Thank you, Commissioner Markwart. Just curious, with the tax rebates, can you, I was trying to remember, the tax increase that people got on the tax rebate because of something that didn't happen with the administration, can you tell us where things fell down with state government and why people ended up with a tax increase out of this, what was supposed to be a tax rebate?
Madam Chair,
Commissioner.
Senator Drazkowski, I won't accept your premise on the question, but on the next slide, we do talk about the federal taxability if we could. So that's all. Well, are there any more, we do talk about the taxability on the next slide, Senator, but are there any more?
I'll wait for that. Thank you, Madam Chair.
Yeah,
Thank you,
we can-
Commissioner.
If there's more on this
Thank
one,
you,
we
Senator
can, otherwise I can go to that.
Drazkowski. Commissioner, then you can continue, and maybe you can answer already, however, the extra taxes that Minnesota taxpayers are going to pay, is that going to be reflected in the February forecast?
Madam Chair, I don't know the answer to that right off. I'd have to
We're
think
very
about.
sensitive to the forecasts around here.
Yeah.
It would be
Yeah,
very
it's-
interesting to know if it has any effect whatsoever, because we know there is some. So I don't know if Senate Council has any information about that from MMB?
Madam Chair, was the question whether the taxability of the rebate checks would have an effect on the February forecast?
Because Minnesota taxpayers are going to be paying taxes, federal taxes on them. I'm just trying to understand is, on these taxpayers, the revenue is going to the federal government, not to us, because they're not taxable, but is there any wrinkle that would have an impact on the forecast? I mean, I'm expecting you to say the answer is no, but I just want to be sure.
Yeah, Madam Chair, I would think the answer would be no, because
Okay.
you're exactly right. It's increase in your federal taxes, and I can't see where it would have an impact on state taxes. So,
Thank you.
so if we could move to the next slide. So this certainly is a great source of disappointment. And the one-time rebate is federally taxable. And so before I kind of go into that, because of that, a 1099 miscellaneous form went out to every single recipient. Whether or not you cashed it or not, the check, we sent that out. And so it would say if you had $260, it would have $260, and then there was instructions on the form as to how to do that on the federal form, and then where you would subtract that back on the Minnesota form, so you would not be paying any state taxes. So let me just kind of go over things, and then Senator Drazkowski certainly get back to your question. So there's a lot of talk about how to design this. And the main purpose was to ease the pain of inflation and to address the burdens of the pandemic. And so one of the ways, so back between 1997 and 01, in 97, 98, it was a property tax rebate based off your property tax, certain percent. In 99, 2000, and 01, it was based on sales taxes. And so that was looked at, and that probably would not be taxable federally. But the idea was, if we're actually looking at trying to relieve the burden of the pandemic, we know that folks who could not work from home, those in the hospitality industry and others, which tended to be lower to middle income, were impacted differently than those probably in upper income. So one thing that happens when you do a sales tax rebate, and you go back to your tax incidents and so forth, because you have to kind of approximate it. Someone, let's say, I actually looked at, back in 2000, there were some forms, but if you were back at that rebate, if you were in like the $30,000 income range, you probably got about $300 rebate. And if you were in the 140,000, you probably were over $1,000 receiving that. And that was not the rationale of what the administration wanted to do with this. And so they wanted to at least keep it equal. So did not go with the sales tax route, instead a refundable tax credit, which was $260 across the board.
Commissioner, was the 2001 sales tax rebate? I don't recall, I mean, I was here. Was that refundable or not? Are you saying that one was not refundable?
I don't, Madam Chair, I don't know if that one was refundable for sure or not. I don't remember. I might have that,
Yeah, maybe we can find, I'm just, no particular point in it, just trying to understand the differences.
So, and then we designed it, we went back to 2021 tax year, because that was kind of in the heart of the pandemic, right in that. So that was one reason for that. Made it refundable, and then modeled it off of many of the states that in 22, the IRS said they were not taxable. So we followed a lot. So quite frankly, I was telling folks and others, I had high confidence that this would not be federally taxable. Never 100% sure. So at any rate, IRS issued some guidance in February of 23 that really covered those that had done the rebates in 22. And they basically said all of those, for the most part, would not be taxable. And I do think IRS was kind of under pressure, because filing season had already started, and they just kind of said, we don't want to kind of deal with it, so we're not going to contest it, and we're going to say it's not taxable. Because California, a lot of states had already were in the midst of filing. And that's what they kind of said. But at any rate, after the tax bill was signed by Governor Walz in May 24th of this year, the very next day we sent a letter to the IRS saying, can you give us some guidance on the taxability of this rebate? So went around and around, and we asked again in September, and finally in November they gave us a preliminary decision saying it would be taxable. They said it did not fall under the welfare exclusion because the income limits were too high, even though California went, I think, up to 500,000. I mean, you know. And then they said it did not follow the disaster relief. And at that meeting, they kind of hinted that because it was, they didn't say this was for sure, but they hinted that it was because the bill was signed on May 24th, and the disaster declaration ended May 11th. So they said it was afterwards. And yet, very clearly, under Section 139 of the Internal Revenue Code, it doesn't have to be within the time period of it. It has to be in connection with a disaster. Because think about it, if you've got a tornado or a flood, you know, that disaster might last only a short period of time, and yet funding requests on that come in later. So it just makes sense. So, the governor and others then began to really say, hey, this should qualify under disaster relief. And so we met twice with the commissioner of the IRS, Danny Werfall, in December. And at that point, he said, okay, yes, that is true. The date doesn't matter. He said, that's not determining at all. The fact that you did May 24th to May 11th, that doesn't matter because he agreed, yeah, it's in connection with. And so there was speculation that that was, you know, because that date was later, that's the reason, but that is not it. But what he said is there is no clear evidence that the rebate checks were pertaining to the federal pandemic disaster because there was nothing in the wording of the legislation that said pandemic. We informed the IRS commissioner that we don't typically put purpose statements in our tax bills unless it might be a tax expenditure, which I know, Madam Chair, there's always some questions about that. But at any rate, that was it. So he said at that meeting in December, come back and show us evidence that there is a connection. So at that point, went back, governor formulated a letter. We showed them and gave them excerpts of 5 committee meetings of the 2 House Taxes Committee and 2 Senate Taxes Committee and the Conference Committee where I talked about easing the pain of inflation. And we gave them right where to look so they didn't have to look through the whole, you know. And then we also provided them 2 press conferences where the governor and I talked about this being linked to the pandemic. Also had letters from you, Madam Chair, and Chair Gomez
Representative Gomez,
indicating that
right.
this was this. And we had other things linking the inflation to the pandemic and so forth. So we sent that to them and then met again. And basically, the commissioner said that the legislative record does not provide the kind of clarity needed to show that the purpose was for that. So it's disappointing because I think the intent was always to do that. I think Minnesota, as we told the commissioner, is treated unfairly. Here you have other states that, here Minnesota suffered in the pandemic just like every other state, and yet we're not being afforded the same tax benefit as these other states. But it ultimately is the IRS determination. I'm not going to go any further than that. We accept it. It's disappointing. And I guess there was never any guarantees, but and we certainly can provide the letter we sent to Commissioner Werfel, but I just think there was a clear connection between our legislation. But it really came down to a question was asked, is there any changes we could even do yet in this legislative session? And he said, in the future, put the intent into basically that type of a bill. So that's really what it came down to, is there was not clear wording that this was for the pandemic.
No, actually,
so-
Commissioner, there's more of a move to remove purpose statements from the statutes because they're meaningless. They're they're puffery, and they're meaningless. And so we're probably going to have an ongoing disagreement, not only by the administration, but by the legislature, of putting meaningless language in our statutes to serve a bureaucratic demand that's not necessary. Read the plain language of the bill, listen to the testimony, and the IRS should be able to do that as well as we do. So we very much support, Representative Gomez and I very much supported, and when we're asked for a letter from the administration, we're happy to accomplish that, worked with Ms. Bears to get it right and send it off to the commissioner, and then, of course, it became public when you were making a presentation to the commissioner. So we were happy to do that.
Yeah, no, Madam Chair, thank you so much. I get, you know, like I said, it was a big disappointment. We've got a good working relationship with the IRS and that, but, you know, this is in, you know, we grudgingly accept the decision, of course, and we have to do. But, so what is the impact on taxpayers? So primarily those that would fall into the parameters of the income up to 150,000 would fall into the federal tax brackets of 10%, 12%, and 22%. So on a $260 rebate, it would be $26, of course, at the 10%, and up to $57.20 federal tax on the 22%. And even, I will say that about half the states did a rebate. So, I mean, let's not lose sight of this, that only about half the states did any sort of a rebate. And even taking off, I think at the $286 that the maximum credit of $1,300 would have, which would take the net benefit down to $1,014 or whatever, that still was the 6th highest maximum rebate in the nation. So, I mean, just to keep that in perspective, that, like I said, half the states didn't even do a rebate, and ours, even with the, you know, the paying back the federal portion, it still was one of the higher maximum credits in the nation. So, Madam Chair, that's my presentation on this part, certainly.
Senator Driscollowski.
Thank you, Madam Chair. Thank you, Commissioner. So it turns out that it's, you know, how the language was written, the decisions that were made on how the rebate will be structured. It wasn't a property tax rebate. It wasn't a sales tax rebate. The decision was to make it an income tax rebate. And, you know, we can castigate the governor or your office. We can castigate the legislature because we were lazy. But I really see this as tying back to the discussion we had yesterday about net operating loss, Madam Chair. It sounds to me like, and it's very likely, the language was written by the department. And we as a legislature members have to take our responsibility as a legislative branch. We write the bills. And for us, whether it's the Department of Revenue, Department of Commerce, Department of Transportation, or any other department here in the legislature, if we sit back and allow them, the executive branch, to write the bills, this is what we get. We get less people providing the scrutiny over the language that comes forward. Because remember, if we write the bills, the executive branch is going to provide scrutiny. If the executive branch writes the bills, the level of scrutiny here diminishes immensely. And that's what we've got. We've got to take back our responsibility as a legislature, whether it's this issue, whether it's net operating loss, whether it's something in education or any other area. And it's our job as legislators to write that language to begin with. Because when we wait for some sort of agency bill to come forward and land on our desk and put it forward, the disposition then is, it's got to be right because the agency wrote it. And at that point, the number of eyes, ears, brains, and other things that go into that bill is very limited. It's our job as a legislature to take over the legislative responsibility, and it matches with the discussion that we had yesterday. Thank you, Madam Chair.
Thank you, Senator Driscollowski. I don't disagree with what should be the burden of the legislature, but also in the future, if we have not, or we should have learned our lesson. And in the future, even if something comes into a conference committee, we need to have a full hearing on the language that is going to be suggested. And that That policy is something that I've already spoken to the commissioner about and have had, and will continue to have ongoing conversations with Chair Gomez that the best we can, it's not going, we will try not, we can't ever say you're going to be perfect, but that we hope it's going to be a lesson well learned for the scrutiny that will come to particularly proposals that arise during a conference committee. If we had had, I believe, if we had had an actual hearing in the conference committee, for example, on the standard deduction feature, the error of not including those other years would have been immediately discernible by either House Research and certainly by Senate Counsel. There were extenuating circumstances. There was a perfect storm that occurred in that whole process that worked against that happening. But Representative Gomez and I are committed to saying at some point when something new comes in, which sometimes it does, that we're going to say, hey, wait a minute, we're going to discuss this in public, not just in private. The PACS committee, conference committee was the only one that I'm aware of that had regular meetings where we had, we didn't have testimony, but we did have public discussion among the 10 conferees, and we hope to continue that practice. So so saying that we agree with you, or that I agree with your description, is not good enough. We have to consider how do we move forward so that that is not going to be a routine lack of expectation, if you will. And, you know, it happens in other committees too, but the tax committee and last year's bill was extremely complicated and complex, and there were some conditions that were beyond our control that would have been very, very helpful in putting forth that extra layer of scrutiny. Not to find fault with how that came about, but it certainly was a factor. But your criticism is well taken, I believe, and I see Commissioner Marquardt nodding his head. Both the department and the not only the nonpartisan staff of the legislature in both bodies, but also the partisan staff can contribute very immeasurably to making sure that we get it, that what we produce and the impact is what we absolutely intended. So thank you. Commissioner, any further comment now?
No. Thank you, Madam Chair, and thank you, Senator Truskowski. All very valid points. Appreciate that. So we have one more slide, if that would be
Yes,
fine,
yes.
and then I'll go through this. So I know I'm running short of time here. Appreciate this very much. So kind of looking ahead for next season, 2025. So, you know, we're certainly, you know, got things going for this tax season. Now we're working on some new things for next year. And one of the things that was authorized in the child tax credit legislation was to be able to do advanced periodic payments. So the department right now is working with advocates, the governor's office, in coming up with a design. I mean, no other state has done this. It's not easy to do. And we want to make sure it's a system that allows families to be the decision makers, to give them plenty of information, and set up a system where you could, right now what we're looking at is you would get an advanced payment, maybe like starting in July for 6 months, that would be equal to half of your credit that you're receiving in the prior year. So we're looking at that. We're going to, as we get more information, we'll broaden the number of stakeholders that we have as we look at designing this. But we want to make sure that when it starts next year, it is solid and it's got integrity and it's going to work. So might not even have everything that ultimately it would wind up into the future, but we want to get things started because we know with child poverty reduction that if you can give families more options and flexibility as far as their budgeting, and that it makes that even more effective, makes the child tax credit more effective. As mentioned before, we're moving.
Commissioner?
I'm sorry, Madam
So,
Chair.
in the past, you know, the earned income tax credit, the federal credit, provided for periodic payments ahead of time, and then there was a settling up, if you will, at the end, and by taxpayers, which had a real measure of uncertainty about it for
Yeah.
taxpayers, leading to some of them not wanting to take it at all because they didn't want to have to pay back. And I appreciate the efforts that the department is making so that no taxpayer is going to be put in that position insofar as our policies directing that payment will happen. And we didn't do that with Minnesota Working Family Credit. It was not an advance payment one.
Right.
And so we never had, you know, it's a benefit, but then not so much a benefit. They got it in the tax return, but not periodically. And so we didn't have the same dilemma and the same opportunity that we're having now with the child tax credit. So there's the positive, and then there is the caution to make sure we're benefiting taxpayers in the way in which we want to achieve the result you mentioned about getting it in a regular period rather than waiting until year end.
Well,
Your
Madam
response,
Chair,
and then I'll
you
call-
are.
And then I'll call on Senator Nelson.
Madam Chair, you're exactly right. I mean, when you've looked at some of these where there's been small-scale advanced payment programs, what has kept folks from getting involved is this uncertainty as to what they might have to pay back from what
Yes.
they receive. So we're looking to mitigate that up front with a safe harbor maybe on the back end of it. So a portal, and it mainly would deal with income. So we don't want to create disincentives for people to increase their income, or a spouse might get a job that didn't
Exactly.
have one. So we'd set up a portal that you could immediately opt out, or, you know, provide some other safeguards that would try to prevent that. And now the federal government set up kind of a safe harbor based on income, that you had to pay a certain percent back, but you were not having to pay a certain percent back too. So, I mean, there's a number of options, but you don't want to create disincentives to increase
Is the
income.
program that you all are designing, is it quarterly payments that you're looking at, or is it half-year payments or monthly? What looks like to be the most doable that meets all the safeguards that you're speaking of?
Madam Chair, we could do either quarterly or monthly, either one. But I think if we met with the advocates, I think they like the monthly, starting in July, like the second half of the year. It gets a little more difficult in the beginning of the year when you're doing the filing and so forth. And you'd always receive kind of the catch-up when you filed, or if it's the first time, you'd get your full credit, and then the advance payments would start in July. But I will tell you, this is only draft. I mean, these are some things
Sure.
we're thinking about. And certainly could be quarterly, but I think right now we'd probably be looking at monthly type payments.
Thank you, Commissioner. Senator Nelson.
Oh, thank you, Madam Chair. If the commissioner's finished with the presentation, I have a kind of a straightforward question. I don't know, do
No,
you have
he
a couple
hasn't
more
gone-
bullet
He hasn't
points?
gone through the rest of the items on this page. Could you wait a minute? then?
I definitely can.
Okay, Commissioner, if you want to finish.
Madam Chair, I will do that. So on e-services, we're looking at how we can meet the customer where they're at with phones and stuff, where they get information portals back and forth. And then a huge goal always, and any help you can provide on this, is trying to make this tax code simpler and more understandable. That's really what we want to do. So thank you very much for allowing the department to talk about implementation.
Of course.
Appreciate that.
You did, I don't know that you emphasized the renter's credit change that's being made, but that will come on next year's return, or this year's return in 2025 and be shown there. Senator Nelson.
Thank you. Thank you, Madam Chair, and Commissioner, thank you for the recap. There's one thing that I didn't see in this recap today, but it's a lingering question in my mind, probably other taxpayers as well. Can you refresh my memory? I think there were some retroactive taxes in the bill last year, and the discussion about the NOL changing that effective date, the mistake on the effective date got me thinking about the retroactive nature of perhaps that, if that doesn't get fixed. And I think there were some other retroactive tax changes last year. And I guess my question is, if you can kind of refresh my memory on that, and then I have some questions depending on what I hear about that.
Thank you.
Commissioner?
Madam Chair, Senator Nelson, Ms. Bear's trying to think, we're thinking the federal conformity bill, of course, went back on some things, but I don't know if there was, I know GILTI started in tax year 23 this year, but I mean, that, I don't know if that'd be retroactive. I mean, it started, a lot of times we've got tax bills that start the year, the budgets, you're budgeting, but I can't, I might be missing something, but I'm not thinking anything off the top of my head that was retroactive.
Madam Chair. So
Senator Nelson.
kind of the NOL piece kind of got me
Yeah.
thinking about that. Those folks have already filed the 2023 taxes, and now all of a sudden, there was an effective year jump. It's jumped up a year ahead, so I was concerned about that. But I was thinking about GILTI and other, so the question is, maybe a retroactive or very short timeline, they have planned their 2023 spending, for example, or finances, and then all of a sudden there's a tax change that shows up in August. You have a few, so you can't really adjust your business plan accordingly when you have such a short time frame. But my question has to do with when those cases happen, as they will or do, what's the status of penalties? And are the penalties onerous? Are they, for example, on this NOL piece, are there going to be penalties that folks are going to need to pay based upon changes in tax law that might have happened on August 1st for that particular year? I'm just very cognizant of penalties for tax decisions that occurred before the law, that they were suddenly going to be penalized for if not paid.
Yeah, thank you, Madam Chair. Senator Nelson, no, that's a good question. So like in May 24th, we said things wouldn't take impact for tax year 23. So you're already 5 months in the tax year 23. But of course, the filing isn't due until the next year. So like an individual taxpayer, there's no impact. Now, on businesses with estimated taxes, I suppose they'd start paying that. It's March and June, it's quarterly on some of that. But I mean, that's not uncommon that we start things with that calendar year, the same year you're doing the budget. And like, so for the NOL, I mean, it would be following law, which we're doing, which means it started in tax year '23. Even though the intent was '24, the Department of Revenue is following the law on that. So I don't know what penalties and interests are, but it just follow normal
So
law.
Commissioner, just following up on that, the timing issue. So if we passed some sort of tax savings, general tax savings in our 2023 tax bill that applied for taxpayers for tax year 2023 for Minnesota income, would the department adjust the withholding tables?
Madam Chair, yes, we probably
Yeah.
would, and that is
And
one
so
area-
the
yes.
tax benefit part of it, the department gets right on to apply over the whole year to reflect that tax savings.
Yes, and Madam Chair, my understanding, and of course, the commissioner has a lot of discretion on the withholding tables.
Yes,
right?
we know
Especially
that.
when the standard deduction occurred. But like, if there was a bill that only affected a small number of people, you would not change the withholding tables. But if it was like a standard deduction that went into
Right.
effect right
Or
away.
a tax rate or something.
Right, exactly, then you would adjust the withholding tables.
So just to follow up,
Senator,
well, I wasn't quite finished,
Look,
Madam Chair.
just a second.
yeah.
Was there a comment from staff? No. Oh, okay, sorry. Senator Nelson, continue then, and then I'll call on Senator Weber.
Thank you so much for the clarification and just being cognizant of that time frame. And then particularly, though, on the change in effective date for the, I don't know, about 16 million, I think, 16.9 million increase in taxation due to the effective date change, the mistake, the, unintended 23. My question there is, though, I don't think they knew. I mean, I don't know. When did we know, when did they know that suddenly those taxes were going to be due? I mean.
Immediately, Senator Nelson, because the department and the two tax chairs called attention to it, June 7th.
Yeah, so they would, but I think the point, my question I'm trying to get to is, when did they find out that this is in doubt? In other words, so the tax chairs made a point to say that the effective date was moved up, not as intended. And now, as we were talking yesterday, or maybe looking at what the governor had put in his comments at some point, was that, no, we're not going to fix that. We're only going to fix, the standard deduction mistake. So my question is, when is it that the folks affected by the effective date move up of the NOL, when is it that they knew that suddenly that correction wasn't going to be fixed? Think they still don't know. And some of us are hoping that it will be corrected.
Well, Senator Nelson, I think in our discussion yesterday, I indicated that the two tax chairs were committed to correcting that error. And then we did not get the support of the governor and the administration that we had anticipated since last June on that error. The two errors are of a different nature. The one thing I think I can say is if the error had gone in the other direction, that is, we made the spreadsheet showed 2024, and the language in the bill said it was going to be effective 2025, we wouldn't be having this discussion.
Correct. So So when was the governor's position made known? That's probably the
Commissioner.
date I'm looking for. When was the governor's position made known that he would not accept correcting the effective date on NOL? That's what I'm trying to
Yes,
drive at.
Commissioner.
Madam Chair and Senator Nelson, that's a great question. So the letter that was sent to myself as Commissioner of Revenue and Commissioner Showalter by the chairs, tax chairs, Rest and Gomez, said that we would like to do this at the earliest convenience, but then they also asked the department to go with the intent of the law, which means hold off until 24. And at that point, we did not agree to that. We said, no, we have to
But
go
Commissioner, you
with
did
the-
put a statement on your website that supported doing it as early as possible.
Yeah, no, so what, right, and so we send out, always the thought was, we're going to, and businesses knew this, that we were going to enforce the law, which means it would be tax year 23.
And businesses assumed that.
Right, yeah, I mean, that was, so businesses knew that. They also knew that it probably would be dealt with early in the session also. But from the department, it was follow the law. And the law is tax year 23 start.
Senator Weber. And members, we do have another report coming that some of us find even more interesting than this one. So I do want to get that and to hear from from Jason North. But Senator Weber.
Thank you, Madam Chair. I understand what you're saying, Commissioner, but I think that what Senator Nelson was referring to and what I'm referring to right now is the fact that there was a promise made that mistake was going to be corrected by the letter that was forwarded to the department from the tax chairs and by quite frankly, the statement that was put out on the department's website. So my question is going to be fairly blunt. If there is a shortfall and a penalty or interest that accrues to a taxpayer because they believed what was put out there on your website and what have you, do you have the authority? And if you do, will you take the authority to waive those penalties and interest?
Commissioner.
Madam Chair and Senator Weber, I won't comment on that at this time without kind of seeing how things work. But I do know that back in early July, we did a press availability, and we made it very public that we were, and I said myself and the chairs had agreed to fix the standard deduction. And this was clearly after the NOL had come up, and we did not mention the NOL in that. So while certainly the standard deduction, I would say, was part of an agreement to fix early, the net operating loss never met that standard of this type of an agreement that it would be done necessarily right away. And I think it was mainly because of the timing, is that where we had to enforce the law with the net operating loss, where with the standard deduction, we knew that the legislature was going to meet before the law took effect. So the standard deduction wasn't until tax year 24, where we knew the legislature was not going to meet before filing season started in 2023. So that was probably the big difference why we really had this agreement around the standard deduction and not the net operating loss.
Madam Chair, I think we're going to have to agree to disagree on that particular issue, but I do think it's something that you really do need to seriously consider, because many of our businesses who may take advantage of that net operating loss are still small businesses, are startup businesses, and they may not necessarily have an accounting staff that keeps track of all those items. So anyway, thank you.
And Madam Chair, if I might, and Senator Weber, I'm just going to say the department will want to be fair with this. That I can assure you.
Senator Jaskowski. And apparently we've had another glitch in in our technology, so we are not showing on our screens here what is being projected publicly. We just noticed it happened. We're trying to bring that back up. And by the way, just for those who are, this issues in a lot of other committee hearings is coming up as well. And it's pure technology that probably happened, some glitch happened during the interim, and it was not even noticed because we weren't meeting until we have started meeting. So just to ask your patience of the members of the department, people testifying, and the public, and we will correct it as soon as we can. Senator Drazkowski.
Thank you, Madam Chair. Gremlins, Madam Chair.
Gremlins,
Yes.
right. Ghosts.
I've got a different area of questioning. Commissioner, I was just looking at the numbers. We've got the foreign sourced income addition, the guilty stuff, 430 million we're depending on this biennium and 370 million the next biennium. I remember the testimony last year suggested, some people suggested it may be a violation of the Commerce Clause. And there may be lawsuits coming forward. First of all, are there any lawsuits coming forward that you know of? And what do you see in terms of the vulnerability that the state might have to the dependence on this income through until whenever?
Commissioner Mark.
Yeah, thank you very much, Madam Chair. Senator Drazkowski, I'm not aware of any lawsuits, and we think guilty is on very strong constitutional grounds. And, you know, there's a couple Supreme Court cases that back that up. But they always say on, you know, and the question comes down to apportionment. And right now, with our guilty, we go off of the federal form 1120, which is the corporate form, and on those lines, they have to put in the guilty and so forth. And we're basically just taking this income of a company that has nexus in Minnesota and taking what they have to report on their federal form for guilty, and we're taking that income, we're putting it into the apportionment, like a unitary company, and then at that point, giving it a 50% dividend received deduction. So, and the courts have said that you don't have to apportion perfectly on things. And so we feel we're in a strong constitutional situation. And the bottom line is that ultimately, the idea of guilty is that it is domestic income that's being shifted. So it's already really Minnesota income that is being shifted, and we're merely taxing Minnesota income that has through intangible profits and those type of things been shifted to other countries, but actually should be Minnesota income. Now, you know, there's going to be folks on the other side, and I've heard the arguments certainly both ways, but we really feel, and the question is, you know, last year the worldwide combined reporting was proposed, and there was great opposition to it, and yet worldwide combined reporting takes care of all that factor representation and apportionment because it's taking all your sales and all your profits, taking everything in. So, and of course, that was met with some pretty stiff opposition. So guilty is kind of a subset of that. And so, I mean, I don't know if you can have it both ways, is what I'm saying, is that, you know, the worldwide combined reporting, which actually solves the problem, although I will say that we were leery of it as a department because, while we thought the revenue estimate was good, we didn't know if you could collect it for sure because no other state had it, and we just didn't know if we could collect it. And I think it was about $700 million over the biennium. That's a large chunk of money to not know for sure if you're going to collect. So I will say we actually had apprehensions about that part of it. But guilty, has been done by at least half the states. And so like I said, it's more for probably lawyers to talk about this, but we feel we're in good shape constitutionally on this.
Senator Driscoll.
Thank you, Madam Chair. Thank you, Commissioner.
Thank you very much then, Commissioner, Ms. Bears, for being with us. We look forward to working with you on an error-free 2024 tax bill. And we appreciate your service. Thank you very much.
Thank you, Madam Chair. Thank you, members. Appreciate it very much. Thank you.
Next on our agenda is a presentation, as I mentioned earlier, by the Office of the State Auditor that will be done by Jason Nord, who is the TIF Division Director. Welcome to the committee, Mr. Nord, if you would identify yourself for the record. In our packets, we have slides on your report as well.
The Zoom seems to be working, everything's streaming, it seems like it's a problem with the TV, so we might not be able to see it.
Okay, I am informed by Mr. Berggren that the technical issue today is likely to be with our TVs rather than the cameras and/or the Zoom. It is just not going to be available to us. So, Mr. Nord, when you're presenting, you'll not be able to refer to slides that are showing on the TV, but we do have your report and we can follow along with that. I just wanted to make you aware of that, okay?
Very good. Thank you.
So welcome again, and if you'd identify yourself for the record.
Sure. Madam Chair and members, my name is Jason Nord.
And you're going to
I'm,
have to speak up,
Sure.
Mr. Nord, if you want. And again, we've not corrected our microphone issue with how close we have to get to it in order to be amplified in the, works fine on TV or in Zoom, but it does not work fine to amplify within the room.
Okay.
So thank you very much for understanding.
Sure. Very good. Madam Chair and members, my name is Jason Nord. I'm the TIF Division Director at the Office of the State Auditor. Auditor Blaha passes along her regrets for not being able to attend and her well wishes to you. And we both thank you for the invitation to appear today to present our annual TIF legislative report. I'm sorry you don't get to see the animations on the screen that AI has enabled. I know you had a good discussion about that yesterday, but trust me, they're really fancy. All right, so I wanted to start out a little bit with just a brief illustration. So if you wanted to look to the first slide in your handout, just a brief illustration of how TIF works and how it fits within the property tax system as a reminder. So on this first slide, normally when new value is created by private development, the new value is automatically immediately part of the tax base. But if you go to the next slide, you'll see what happens when tax increment financing is used. When tax increment financing is used, the value does not become part of the tax base for the whole duration that the TIF district is active. It does not become part of the tax base until after the TIF district concludes. And so during the time that the TIF district exists, the captured value, and specifically the tax increments that are applied to that captured value, those are used to pay the bonds, the notes, and the loans that finance the development activity that enable the development to occur. And so you might think that that capture of value during the life of a TIF district is a negative, and it would be if TIF isn't needed to make that development occur. But if that development would not occur but for the use of TIF, and TIF is truly enabling that activity to occur, then that's considered just a neutral necessity to enable the benefit of the new tax base once the TIF district ends. So an important part of TIF, and I think local governments across the state are doing a good job of making that assessment of a wise use of TIF is you have to make sure that that but-for test truly applies and that TIF isn't enabling the development. If you go to the next slide with the maps on it, you'll see that the use of TIF is widely popular across the state. Our report reflects reporting filed for 1,669 districts by 384 authorities that are using TIF. There's actually another 4 authorities that are have another 4 districts that aren't included in the report because they did not get their reporting in. And by the way, when that happens, their increment is withheld until they get their reports in. So they won't be included in this report, but.
So there is an incentive to get the reports in because there is a penalty.
Right, right, correct. And I should also point out that this report also reflects some reporting by decertified districts. So not the 1,669 TIF districts that are reporting are not necessarily all active and actively capturing increment. I don't have the exact number, but there's probably a couple hundred of those that are decertified districts that have to continue to report until all of their increment is either spent or returned to the county auditor to be redistributed. So the next slide with the table of types of TIF districts and the 2022 counts. This table summarizes the counts of TIF districts by type of TIF district for both statewide, greater Minnesota, and the metro area. And for each of the districts, I've also included the maximum number of years that those districts can run and be capturing increment. So redevelopment districts, housing, and economic development districts make up 97% of all the TIF districts statewide. The 2 other statutory types of districts are renewal and renovation districts, which are akin to a redevelopment district, but the qualifications are more based on land use issues instead of substandard buildings as much. And then soils condition districts are used to address polluted lands. There's one decertified pre-79 district that's still reporting because it has still has some remaining increment balance that hasn't been used or returned yet. And then the uncodified districts are districts that are essentially authorized by special law, like a soils deficiency district might be an example. So there's a handful of districts that have been authorized by special law and don't fit into the other categories. And then on the line below the total line, you can see there's hazardous substance subdistricts. Those can only be used in conjunction with one of the main types of districts. And it generally is used if you start the redevelopment work or the housing work and you find a pollution. You can use a sub-district to not only capture the new value, but capture some of the existing value to help remediate the pollution that you may have encountered. And I think one interesting thing is that 61% of all the districts are actually located in greater Minnesota rather than the metro. So more popular usage outside the metro compared to the metro. The next slide with the 3 pie charts shows you, kind of illustrates the popularity of the different types. So redevelopment districts are the most common type of TIF districts. And if you look at the metro and greater Minnesota charts, you see that redevelopment is even more popular in the metro area compared to greater Minnesota. In greater Minnesota, the amount of housing districts actually is exactly the same as the number of redevelopment districts. And you can see that economic development districts are more popular outside the metro than they are inside the metro. The next slide summarizes not the counts, but the revenues. So it shows the amount of tax increment revenue being generated for each type of district, again, by statewide, greater Minnesota, and the metro area. And contrary to what we saw with the counts, you may note that 79% of all the tax increment dollars are being generated in the metro area. And I think that's largely because values are higher in the metro area, and probably the scale of development activities is also tends to be larger in the metro area. The next slide then shows the pie charts again to kind of illustrate those numbers. So you can see that 68% of all the increment revenue comes from redevelopment districts. And if you compare metro and non-metro, redevelopment is still dominant in both areas. And you can see that even though the number of housing in redevelopment districts are the same in greater Minnesota, most of the dollars are generated by those redevelopment districts, again, because the scale of those projects tends to be larger. I've also noted on that slide that $13.1 million of tax increment revenue was returned in 2022. That can happen for a number of reasons. Either it's just extra tax increments that they didn't need, so they returned it, or it could be because they received more than they're authorized to spend, or it could be because they've improperly received increment or improperly spent increment and have had to return it to remedy those issues. The next chart shows the tax increment revenues in Minnesota for the entire life of tax increment financing back to 1974. The data for much of this comes from the Department of Revenue, and the more recent data comes from our own data. The top line is for actual dollars, and the bottom line is for inflation-adjusted constant dollars. So you can see that the use of tax increment financing really skyrocketed across the early years, and it actually led to a lot of concerns and reforms that happened in the late 80s and in 1990 in particular. And so kind of from 1990 forward, you see more of a moderated use of tax increment financing, although it did continue to grow. That big drop in 2002 was due to the 2001 tax reforms, where there was class rate compression that occurred. It used to be commercial property was classed at more of a 5-to-1 ratio compared to residential, and in 2001 that was reduced significantly. So you can see that there was almost a third of tax increment that disappeared in 2022.
Mr. Nord, what is the explanation for the spike in the tax increment revenues in 2020, and then the subsequent decrease? What was happening that caused that? Where, as you noted, 2008, there looked like there was a steady decline with just a couple of bumps, and then there began in 2018 up to, trying to find these lines, or 2016, up to 2020, the line goes up and then it starts going down again. What was happening then?
Yeah, Madam Chair, thank you for that question. I actually am wondering a little bit myself. I can explain the rest of the chart pretty well, because other than that drop from 2001 to 2002, it was just basically a steady climb up to 2008. And then the reason why it started going down after 2008 is because a lot of the early districts that were created before the 1990 reforms were all decertified.
I see.
Yeah, so we had this huge downward slide for a number of years.
So it should be something that we expect from those early 25-year redevelopment districts.
Exactly.
These are still, I just noticed in the thing that there's only one pre-78 district that's still
Yeah, there's just
going,
one
and
that's
that's
still
in Greater
reporting.
Minnesota. So
Yeah.
those districts are now decertified, even when they had extended durations.
Madam Chair, that's correct. Yep. Yeah. So that wave of decertification, so I can explain everything through 2017
Okay.
As making lots of sense. I'm honestly not sure why from 2017 to 2020 there was growth and why there's been decline in the last 2 years. So I don't know if it's just a normal aberration of a few large districts decertifying.
Okay.
It may be just that, but there's no, I can't pinpoint a good logical reason as to why there was a little bit of a spike there in 2020.
Mr. Sylvia, other than the phenomenon of the decertifications, was there an uptick in the number of proposals for special legislation that would have shown the increase that we see between 2016 and 2020, or would that not have an effect on that line?
Madam Chair, members, I know that there were a number of years where we did not have an omnibus tax bill. So my recollection is in
I see.
2020, there were a significant number of special laws, more so than we would typically have
So
in a
in-
regular tax bill.
in
but
a
I'm not
sense,
sure if
an
that was
externality.
relevant, but
Relative to having a tax bill. Thank you. Okay. Any other questions to this point? Thank you very much. Continue.
Sure, thank you, Madam Chair. And the next slide then, instead of showing the dollars, shows the amounts. And you can see there that there isn't that spike in the counts over the last few years. This data just comes from the time that our office has had oversight of TIF. If we added the Department of Revenue data for the early years, it would look just like the revenue chart, where it'd be a steady increase up to the peak in about 2004 or 5, where, again, the decline from 2004 or 5 to about 2017 was due to all of those large, long-running districts from the pre-reform years were finally starting to decertify and go away. So you can see we've actually had a remarkably steady number of districts for the last 7 or 8 years there, at right around 1,660 districts or so. So the spike in the dollars is not matched by a spike in the number of districts. So it was likely there was some very large districts that may have decertified the last couple of years, is probably what happened.
Thank you.
And then the next table shows, the dotted line shows the number of decertifications that have occurred over the last 10 years, and the solid line shows you the number of new districts being certified over the last 10 years. So in those first few years, you can see that decertifications were outpacing new districts. Again, that was the wave of decertifications of older districts. And then for the last 6 years or so, those lines have kind of come together and are just bouncing around between 80 to 100 districts being certified or decertified each year. The next slide summarizes the TIF debt. So there's about $1.8 billion of TIF debt in 2022. And you can see that 70% of that is pay-as-you-go obligations. And a pay-as-you-go obligation or a note is generally one where the developer finances the costs. They get their own private financing, and then they're reimbursed through their tax increment over the life of the TIF district. And so the good thing about those is it puts the risk on the developer or the note holder if things don't turn out like they thought, if increment isn't as strong as they expected and they run short, that risk falls on the developer or the note holder. Whereas it was previously the use of general obligations bonds was much more popular, and it's still used it still makes up about 14% of TIF debt today, and that's where the TIF authority is issuing a bond, and the taxpayers pledge their full faith and credit. So if increment doesn't become sufficient to pay off the debt, then the taxpayers are on the hook to pay those bonds. And then there's much less use of revenue bonds. Interfund loans are generally not used to finance entire TIF districts, although that's happened a few times. Interfund loans is when the authority is borrowing money from other funds within the authority, and that's usually done to pay administrative costs. So it kind of makes sense that interfund loans make up about 10% of TIF debt because—
And those are direct payments for the administrative costs.
Right.
I mean, it's a direct transfer.
Right,
It's not part of the debt or anything like that. It's a direct transfer of actual dollars.
Yeah, Madam Chair, so like if they have to pay a consultant to write their TIF plan, they might get a loan from the general fund to pay for the TIF plan, and then the tax increments are reimbursing the general fund. So
Thank you.
it's just those internal loans, and not bonds or PAYGO notes or anything like that. So, and that makes up about 10%. We added a new chart, and that's the next slide. So this chart is new to this year's report. I wanted to kind of illustrate the change in the types of debt over the last decade. And so the top line there that's increasing is the use of pay-as-you-go obligations. So you can see pay-as-you-go obligations went from just over 800 million in 2013 to over 1.3 million in 2022, whereas the use of general obligation bonds has declined over that same period. So it shows that local governments are making probably wise decisions about transferring risk to developers rather than putting that risk on their taxpayers. Otherwise, for the other types, you can see revenue bonds also declined a bit, and the use of interfund loans has very slightly risen over that period. So I thought that was one of the most interesting trends that's highlighted in our report this year. But the next slide, I think, identifies what is, I believe, is the most interesting trend that we've seen recently, and that's the extent of early decertification. So it used to be you'd think, well, a TIF district is going to run for 26 years. That's a long time to tie up tax base. But it turns out that decertifying early is definitely the norm. And so what this chart is showing is it's showing for districts that have decertified over the last 5 years, it shows you the number of districts that have decertified by type, what percentage lasted their full duration, and then in the highlighted column, what percentage of those districts decertified early. And in the last column, it identifies for those that are decertifying early, what's the average number of years early that they decertified. So you can see redevelopment districts, only 21% ran their full duration, 79% decertified early, and on average, they decertified 10 years early. For housing districts, 77% have decertified early by about 9 years. And even economic development districts, which only run 9 years to begin with, are decertifying early 39% of the time and by about 3 years.
I agree. That is probably the most interesting chart that you are providing here, because we tend to think of very few economic development authorities, cities, are going to decertify early because they want to keep, we assume, for whatever reasons, that they want to keep receiving the increment for reasons other than paying off the bonds, and they have the pooling opportunities. But that particularly those, the longer districts, if they are decertifying early, like housing and redevelopment, that speaks well, in my mind, of the responsible fiscal management of TIF districts when they have the ability to decertify early and get the properties back on the tax rolls, which has a positive effect on other taxpayers in that jurisdiction, other property taxpayers in that jurisdictions, that is responsible management. I hope you will continue that chart in particular. It's very interesting to me.
Yeah. Yes, Madam Chair, I share your enthusiasm for this chart. And I think maybe next year we'll add a trend of these statistics so you can see the trend over time. I don't have these on the slide, but just for background, so you understand, the rate of early decertification by housing districts has always been for the last quite a few years, has been close to 80%. But for redevelopment districts, in 2015, only 48% were decertifying early, and now that's up to 79%. And for economic development districts, it wasn't, just a few years ago, only about 22 to 25% were decertifying early,
Okay.
and now we're up to 39% decertifying
Yeah.
early.
That's a great record.
Correct, yeah. And I think the driver of this is the 6-year rule and the 5-year rule. I think that's probably the most important feature or limiting feature in the TIF Act. The purpose of
Do all
the
the work in the 5 years, and then by the 6th year, you're paying off the bonds.
That's correct. That's correct, Madam Chair. And so my last two slides here were kind of meant to illustrate that thought process. So on the next slide, you kind of see what sort of a normal use of TIF might look like. When a TIF district is created, you can see the new value occurs. And so the value line and the amount of taxes goes way up. But for the full life of the TIF district, if it runs its maximum duration, all that additional value is being captured. But you might wonder, well, is that increment greater than the necessary costs that enable development? And you might wonder, is that maximum duration greater than the time that's necessary to pay those costs? And so if you have a rule like the 5-year rule and 6-year rule, which work together, that says your necessary costs are those costs you incur in the first 5 years, and then you start paying those off, and once you pay those off, you have to decertify. That's where you see the next slide, which is, so that's trying to say, once the increment equals the necessary costs, at that point, you have to decertify early. And then you get all that benefit to the tax base. The higher tax base occurs earlier than it would if a district was to run its full duration. And so I think that the 5 and 6 year rule are working well, and we really appreciated working with you last year and with stakeholders to pass a bunch of clarifications to the 5-year rule and 6-year rule to make them
Yes, that
hopefully.
work was very helpful and appreciated by all.
Yes, correct. So I hope that these trends will continue, and we'll continue to see TIF districts appropriately doing what they need to do and then ending early and getting those tax-based benefits, getting to those benefits as soon as possible. So I think that's largely everything that I wanted to present today, and certainly I'm available for questions. I will point out that in our report, there was, we also, in our annual legislative report, we will publish any formal notices of noncompliance that we've sent out during the course of the year. There is one in this year's report. That doesn't mean we only found one problem this year. We generally, authorities are often willing to work with us very quickly and informally to just, if something is noticed, they often just correct it right away. And so we don't often have to proceed to a formal, a notice of noncompliance. So we don't tend to put out a lot of notices of noncompliance every year, but we are monitoring a lot of different activity each year. And authorities are generally very good about remedying those issues when we encounter them. So.
Thank you very much, Mr. Nord. Are there comments or questions, final comments or questions for Mr. Nord? Anyone? Okay, thank you very much. The work that State Auditor and your office has done over these last few years is just an extraordinary service to the taxpayers of Minnesota, and I can't tell you how much we appreciate it. And that's not just the legislators, the cities appreciate it too, because so much has been regularized for them and their expectations that had so much uncertainty connected with it in the past. So we continue to be very grateful. So,
Thank you.
Members, that's going to end our hearing today. We will not be meeting next Tuesday, but we will have a hearing at least on Wednesday. Some bills may be added that we can deal with, but no particular surprises. But we're not going to meet on Tuesday. We will meet on Wednesday. We don't know precisely the schedule for hearing for taking up 2509 that we passed out yesterday. Obviously, it will depend a lot on the schedule of in the House before it comes over to the Senate. So there being no further business before the committee, we're adjourned.